is Sunday, January 3, 2021. Happy New Year. It is episode 149. Should I refinance from 2.75% to 2.125%? This is a 39.6 Facebook and YouTube live finance show. The show that teaches high earners like yourselves how to make your money work for you so you don't have to work for your money. We talk general investing, taxes, real estate, syndications, Airbnb, paying for college, paying for childcare, and even the car you drive. Today we take a few listener questions from the Facebook group 39.6 community. Please join if you haven't already. Today's question is about refinancing. Although I'm going to knock off a couple of questions, other questions first. That I can't really do a whole episode on, so we'll do these quickly. From Gioti from December 30th. Anybody familiar with a non-grantor, irrevocable, complex, discretionary spendthrift trust? No, Gioti, I have never heard of such a thing. Sorry, I have nothing for you there. That sounds like something somebody's selling you. DV, can you tag me in your max premium indexing MPI video, trying to better understand? I don't have a video on this, and I don't even know what that is. So got two in a row here. Yeah, sorry about that. All right, so Christine asked me right before the new year, quick decision on making a refi on her homestead. I refinanced this house this year and got a rate of 2.75% on a 15-year, still currently owing about $300,000. This is a very good rate, 2.75%. New refinance options today include the same 15-year term, but now at 2.125% with $2,400 in closing costs, or a 10-year at 2% with $4,200 in closing costs. Okay, so first of all, these are awesome rates. If rates are, this is not a jumbo loan, and I have a jumbo mortgage, but these are really incredibly attractive. 2.125%, 2.125% on a 15-year. I'm assuming this is a fixed mortgage. That's incredible. So she says further, interest would be as follows, as far as I can tell. The current 2.75% at 15 years would have a total of $67,000 in interest. Okay, if she refinances to 2.125%, it would be $51,000 in interest. And if she did the 10-year at 2%, it would be $32,000 in interest. Now, that's the total interest paid over the life of the loan. Now, obviously, the third one there has the lowest amount because you're only doing a 10-year mortgage. And if you're doing a 10-year mortgage, that's 1/3 less time than the 15-year. And so the interest is a lot lower in terms of total interest paid. But if you compare the 2% to the 2.125%, that's only 1/8% difference. And the difference in interest here is $51,000 versus $32,000. So it's not really because of the interest difference. Interest difference is a tiny, tiny, tiny amount of that. It's primarily driven by the fact that you're paying over a less period of time. I really don't pay attention to those things when people look at how much total interest is being paid. Because remember, if your money is not going to the mortgage, presumptively, now this doesn't actually happen for most people, unfortunately, but presumptively you're taking that cash and investing it somewhere else, right? So there's that time value of money where this comes into play. Like I could show you 3 numbers of total interest paid. I could say you could have 0% interest, or let's say I did 1% interest over 40 years, okay, which is a super low amount. And I could say 20% interest over 1 year. And the total amount of interest paid on the 1% would be a lot higher than that of the 20% paid over just 1 year. Simply because you're only paying this 1 year mortgage out in 1 year. It only accrues interest for a single year. But obviously the 1% interest rate is way cheaper, and that's the way you would go, because in the first year, you're only paying 1% interest. If you wanted to pay it off in a year, you could just pay the whole thing off in 1 year, and you'd only be paying 1% interest on it. So it's really the interest rate that matters, not the term. So in general, the shorter the term, the lower the interest rate will be at any given time. Like if you're refinancing today, a 5-year mortgage should be a lower interest rate than a 10-year mortgage, which should be a lower interest rate than a 15-year, which should be less than a 20, or it should be less than 25, which should be less than 30. That is how it usually is, assuming that the bond yield curve is the way it's supposed to be. But sometimes that bond yield curve actually inverts itself. And so it's possible that you could have a cheaper interest rate on a longer mortgage than a shorter mortgage. It doesn't really ever happen, but potentially can. And the bond yield curve has inverted multiple times within the past couple of years. Okay. But in general, the longer your term is, the higher the interest rates are. So first, let's compare the two options you have if you refinance: 15 versus 10, 2.125 versus 2%. Those two amounts are so small, a delta of 0.125%. There's no way I would choose that 10-year mortgage over a 15, because your monthly payment's going to go up by a lot and you're only getting 1/8 savings. But it's even worse because the closing costs that you mentioned are $4,200 for that 10-year note versus $2,400 for the 15-year at 2.125%. So this is like a horrible deal at 10 years, because you're paying $1,800 extra. Okay, you're paying 0.6% extra up front, and you're only saving 0.125%. So if you're saving 0.125% interest, but you're paying 0.6% extra, that's basically 5 years of interest savings you have to pay up front in that when you acquire the property, when you refinance, just to get that cheaper rate. So that is like a horrible deal. Okay, if you're going to be paying an extra 0.6% in interest, actually, yeah, extra 0.6% in interest or in points on the front end, you better be getting much more discount than 0.125%. Okay, so definitely throw that option out the door. So then the real question is, should you keep your 2.75% for 15 years or go down to 2.125% at 15 years? So that's a 0.6% spread. That's a nice delta, nice reduction in interest. And you have a $300,000 balance, that 0.6%, that savings would be $1,800 approximately in just the first year. And that would continue for 15 years, decreasing over time. Okay, but it would be a substantial savings, and over the life of the 15 years, your calculations are it would be about $16,000, which would be nice. Okay, so that's like 5% of the mortgage principal. Now, the problem with refinancing is the cost to refinance. When you're talking about student loans, in general, right now in 2021, student loan refinances are still free. That is the cost to refinance that's taken on by the refinancing company. They take on all those costs because they want your business. Okay, so you can refinance for free. That may change in the future, especially as refinance rates are getting so low. And I'm considering refinancing again, student loans as well as our house. I mean, if we could get down to 15-year 2.125%, yeah, I'd probably do it. Although I don't, I'm at a 30 right now at 3.375. If I could get it down, I don't like 15 years in general, but if I could get it down to 1.25 point less, yeah, it could be well worth it. Now, the problem here is when you're refinancing, it costs money when you do it on a house. It's going to cost you 0.6%. It's going to cost, it's going to actually here cost 0.8%. $2,400 is the closing costs to save 0.6%. So you just have to look at when's your break-even point. Okay, so your $2,400 is 0.8%, and you're saving 0.6% in interest. So it'll just basically take a year and a third, approximately, 15 months or so, or a little 16 months. It won't take that long to break even. Okay, so if you're going to stay in this house for a year and a half, then you'll break even on it. Now, it's important to note that your mortgage at $300,000, 2% interest, 2.75% interest, that's not much interest, like $8,000 a year. In terms of the standard deduction of $25,000 per year, you are well under the standard deduction. Even after you add your property tax, and I don't know what state you're in, but let's say you're in Texas, and let's say you're paying 2%. That's still only $6,000. So you add that to your mortgage interest, you're at $14,000. You're still well under the standard deduction. So your mortgage interest is not really tax deductible unless you have a bunch of other deductions. Okay, so it'll take you about a year and a third in order to break even on this, which if you're planning to stay there for well over that, like very confidently, sure, go ahead and do it. You run multiple risks. Could it go cheaper? And then you'll wish that you maybe waited a little longer. When I refinanced last year at 3.375%, I thought that I was locking in at a good rate and didn't know it'd be going down cheaper, and it has. And the last time I looked at it a couple months ago, the spread just wasn't enough for me to make it worthwhile. But if it's your own home, you're going to be there for at least a couple years very comfortably. Yeah, it makes sense to do it because you'll more than likely break even and then have some savings thereafter. If you end up selling this property in less than 15 months, you're probably going to lose money on this deal. Okay, now, if you are, you don't mention a 30-year, and if you were to have this be a rental property, you may want to consider refinancing to a 30-year. I don't know what rates you're getting at 30 though. Like if you're getting 2.5% on a 30, and that's less than the 2.75% on a 15, that's actually a pretty attractive option if there's a possibility that you're going to have this be a rental property. Because if this is a rental property, then you want this to cash flow, right? And so by having the smallest payment due every month, you're more likely to cash flow. Okay, now there's another question I ask. Do you have any other debt, like student loan debt at, 6.8%? That would be, very high rate if you're still paying that from before. You should have refinanced it if you're not going for PSLF. But even if you have refinanced it and you're paying like 4%, if you have student loan debt, you may actually want to consider doing a cash out refinance and taking out equity from the property. I don't know how much equity you have. I don't know how much it's worth. But let's pretend this is a $500,000 house, okay? And you owe $300,000 on it. That means your equity is $200,000. Now, you only need to have 20% equity in the property to get regular good mortgage rates, okay? And so 20% on $500,000 house would be $100,000. And that would give you $100,000 of extra equity that you can take out. So you could refinance this to a $400,000 mortgage. You could do that on a 30 or a 15. And that extra $100,000 you could use to pay off higher interest debt, student loan debt, which also is not tax deductible because I assume your income is high enough that you're not deducting student loan interest. Because if you're getting in at 2.125% on a 30, that is probably cheaper than student loan interest that you have, unless you have a variable rate student loan interest that has gone below that. But it depends what rates you're getting. You can also consider refinancing your student loans. Okay, so I'm considering refinancing student loans, like the 5 years, you can get some 5-year variables under 2% right now. I've actually been holding on to ours at like 20 years at like 4%-ish. Oh no, higher than that, closer to 5%. That was our initial plan when we finished training, and we've been paying minimums on 20-year notes. But we've refinanced multiple times because at the end of the day, we wanted to maximize our cash flow for investing in other places. But now where we are financially, if we can bring our interest rate down to 2%, then yeah, it could be well worth it. And variable rates aren't that bad, especially on a short period of time. And when you're paying fixed rates, you're basically paying a premium to get kind of insurance on your rate. So you're actually paying extra above and beyond what you really need to be paying. But it gives you the security that it's not going to float up too high. But if you're doing it over a short period of time, and we have such a huge liquidity buffer now, like we have enough cash or liquid assets that we could just pay off all of our student loans all in one check if we wanted to. It puts us in a very safe position to take on a very short-term variable rate loan and then consider, paying it later in a lump sum if we really need to, if the rate starts to float too high. But going down from like 5% to 2% could be well worth it at this point. Now that we've already put in our 5 years doing the plan that we did, and we've built up a ton of assets. So let me see if you have any questions here. Okay. All right. That's it for today. Episode 149. It's a very good question. Christine, thank you very much for asking it. Any listeners out there, feel free to ask more questions in the group, and I try to get to all of them. Until episode 150, it'll probably be on Wednesday, January 6th. And then I get my COVID vaccine, number 2, on the 7th. That's exciting. All right. Again, this is not legal advice, professional advice, professional financial advice, accounting advice, anything other than entertainment for myself and hopefully for yourselves. Until next episode, have a good one.